Credit risk management has three challenges. I'm Juan Carlos, banking data scientist, and I built Crew to solve them. 1. Credit risk is the most frequent supervisory deficiency. Crew's answer? A React agent that monitors the portfolio 24/7. 2. Opaque AI decisions harm borrowers and cost banks millions in penalties. Crew's answer? SHAP plus LIME, compliant with ECOA and the EU AI Act. 3. Miscalibrated PD models distort provisions and capital. Crew's answer? Isotonic calibration aligned with IFRS 9 and Basel IV. The dataset, 307,000 applications, 8% default rate, figures assumed in dollars, giving $1.5 billion in cost. Let me show you Crew from three angles. For the data scientist, 5 phases: EDA, feature engineering, XGBoost modeling, SHAP explainability, and an autonomous AI surveillance agent. For the model validator, XGBoost with a business threshold of 0.79, trained on 216 features from 7 data sources. Recall of 65%, the model detects 2 out of 3 defaulters. Gini of 55.6%, well above the Basel III minimum. AUC of 0.27, more than 3 times the random baseline. For the regulator, every design decision maps to a specific framework. Isotonic calibration covers Basel III and others. PSI monitoring covers SR 11.7 and FINMA. SHAP plus LIME covers the EU AI Act and ECOA. Fairness analysis prevents discriminatory lending outcomes, and the React audit trail covers SR 11.7. This is the Crew dashboard, live on Streamlit Cloud. 5 analytical tabs, all controlled from a single sidebar. The decision threshold slider is set at 0.79. Move it, and every metric across all tabs updates live in real time. At this setting, 2,700 loans are flagged for review and ready as a one-click CSV export. The individual risk calculator scores any new application on the spot. Look at the PD and the ECL. If I double the monthly payment, it reads debt service pressure, not repayment speed, raising the PD from 7 to 22% and nearly tripling the ECL. The top SHAP drivers come ready as an ECOA adverse action notice. The technical architecture panel shows the full pipeline, the cost structure, and the regulatory frameworks aligned. For any model reviewer, Tab 1 is the risk manager's morning briefing. Here, among these business insights, the most important AI agent finding is this one. So, bureau data quality is paramount. And the most operationally powerful recommendation: do not wait for a missed payment. Monitor these 3 signals in real time. When they occur, flag the borrower. That is the early warning in Crew. Now, the business case in one number. At this threshold, $1.5 billion in net savings against the cost if the bank had no model. The real risk? 54,000 Stage 2 loans requiring lifetime ECL provisioning. Crew flags them before they become Stage 3 losses. The risk band table converts every PD into an operational action. Above 70% means act right now. At 0.79, we miss 4 out of 5 actual defaults, and with this FPR, we forego $88 million in good loans. Now watch what happens at the statistical optimum. Recall jumps to 65%. But with this FPR, the model flags thousands of borrowers who will not default, and the foregone loan profit goes from 88 to 700 million. Now see the KPIs. With this threshold, Stage 2 went down and Stage 3 jumps up. Expected net profit is under 1 billion, back to 0.79. Stage 2 goes up, Stage 3 goes back to under 3,000, and the profit rises to 1.5 billion. This threshold derived from real loan economics, capital efficient and evidence-based. Tab 2 shows the model performance. An AUC of 0.78 and a Gini of 0.56 confirm that the model works. Profit peaks at 0.79, far from the statistical optimum. Raw XGBoost underestimates high PDs. Isotonic regression fixes that, following Basel III and IFRS 9. Here is the full recall precision profit trade-off across 9 threshold options. The model finds this optimum automatically. The final check rounds out the reliability case. The monotonic progression is what a regulator wants to see. Tab 3 proves the model can explain every decision. The external bureau score dominates feature importance. The B-swarm shows direction and distribution across the full portfolio. These plots show nonlinear relationships the model learned. Each one encodes value, SHAP impact, and an interacting feature by color. In employment duration, 0 to 3 years higher risk, then drops, and in 10, it stabilizes. This control covers 3 confusion matrix quadrants. These fields allow us to compare customer profiles. Let's look at 2 failure cases. First, a false positive. The waterfall shows exactly why the model rejected this borrower. External bureau score .242, a 67% prior refusal rate, and 7 simultaneous active loans. 3 signals all pointing toward rejection. Home Credit's own system approved anyway, and the borrower repaid, a statistically correct decision that was individually wrong. Case 3 is the dangerous failure mode. The bank approved this loan and lost the capital. 10 years of employment and 0 refusals. The borrower you want to lend to. The waterfall is almost entirely blue. Every feature argued for approval. The default came from a shock after the application that the model don't detect. Lime independently confirms the same top features, same conclusion, different method. That agreement makes the explanation defensible. Tab 4 shows an autonomous AI agent that monitors the credit portfolio without human intervention. The agent is Claude Sonnet 4, wired to 5 tools and executing a 5-phase protocol. These are the findings. 5 phases. Phase A flags 2 data quality issues worth investigating. Phase B puts 7,000 borrowers above the business threshold. Phase C confirms the same primary driver across all 5 critical exposures. Phase D translates that into 4 concrete recommendations. And Phase E runs an independent subagent that cross-checks the math. 4 out of 4 checks passed. The KPI panel gives the headline, 16,000 borrowers under active surveillance. This table tells something more nuanced. The model output is stable, but one of its key input features has drifted significantly. This is the audit trail. Every tool calls the agent made logs sequentially. This is the agent's actual reasoning, step by step. Look at Phase E. The verification subagent logs each check individually with the method and the result. EL math per borrower, among others. Finally, regulatory compliance. SR 11.7, audit and oversight. Basel III 4, capital and stress. And IFRS 9, forward-looking provisioning. Next tab is the regulatory backbone of CRU. 3 jurisdictions, 8 frameworks, 1 system. Section 1 shows what is already in production and what is pending. Like disparate impact testing, this is deliberately honest, as SR 11.7 expects. Section 2 flags some features with direct fair lending exposure. SHAP quantifies exactly how much each protected feature contributes to individual decisions, so you can defend an adverse action notice. In the governance section, CRU is classified as Tier 2 material under SR 11.7. The monitoring schedule runs from daily alerts to annual fair lending audits. This button exports the full model card as JSON, the format required for regulatory submissions. Regarding this central formula, CRU provides the PD. The 3 staging criteria map directly to the IFRS 9 standard, and the 3 scenario weighting follows IFRS 9 requirement of probability-weighted forward-looking adjustments. In Section 5, ECOA, GDPR, and IFRS 9 apply simultaneously. This is the process to generate an adverse action notice. And this is a concrete example for this application ID, 4 SHAP-derived reasons in plain English, retained for 7 years per U.S. regulatory standard. Under Basel IRB, CRU's PD estimates feed directly into risk-weighted asset calculations. The stress scenarios in Notebook 5 connect model output to capital adequacy assessment. This is CRU classification under this EU regulation. Articles 9 and 14 are partial by design. Drift monitoring is built, but not yet automated, and human override is intentional. Full compliance will apply from August 2026. For Swiss banks, CRU aligns with FINMA Circular 2017-1 and Guidance 3/2024 on AI. The SHAP plus LIME dual approach directly addresses FINMA's emphasis on model interpretability. Independent validation remains pending. Completing the Swiss picture, CRU aligns with the NDSG. For instance, Article 21 on automated decisions is covered by SHAP waterfalls. 22 requires a formal DPIA before Swiss production deployment, and that is explicitly recommended here. To close, I'll show the intellectual foundation of CRU and next steps. 30 architectural decisions, 22 issues fixed, and a stable PSI. Every design choice grounded in peer-reviewed research. PSI followed Yerdakul and Naranjo. Threshold selection came from Fluss et al., profit-based optimization, Verbraken et al. XGBoost followed Biquet et al. LIME explainability came from Ribeiro et al., and the React framework followed Yao et al. The road ahead follows the natural production path. For instance, survival analysis for more precise ECL classification, a champion challenger framework to validate XGBoost, and a fast API endpoint returning applicant scores in under 200 milliseconds. If you are building a banking data science function, my contact details are on screen.